The Fed holding rates steady this week, now only signaling one cut before the end of the year. The equity market still digesting that latest commentary. Our next guest saying that the credit market is in more of a holding pattern and the loan market could soon maybe be due for repricing. Let's talk about it, where the investment opportunity is. We've got Michael Anderson. He's Citigroup's head of U.S. credit strategy. Michael, it's great to see you. So let's first just take a step back. When we take a look at what we heard from the Fed this week, that lack of reaction maybe that we saw play out in the credit market, what do you attribute that to?
Yeah, a lot of it is just due to the fact that the markets have tightened a lot. There isn't a lot of upside in either the high yield or the loan market. So if you think about the high yield markets in terms of spread, the spread has been locked around 300 basis points in a very narrow range for the last 3 or 4 months. And of course, we've seen a lot of volatility in recent years. And then on the loan side, loans are floating rate assets. They are also callable at par generally very quickly after new issue. And so with the vast majority of the loan market trading above par, there isn't a whole lot more that it can go up. So risky assets generally were cheered by the inflation news and to some extent the Fed. But for the most part, credit right now there just isn't a lot of upside to participate in a rally.
So then, Michael, what questions are you getting from clients specifically regarding kind of the path to rate cuts as it does start to become a little bit clearer? What are they asking you about next moves and potential catalysts in the credit space?
Yeah, I mean, well, first on the Fed side, our econ team is expecting the Fed to cut in September and then to continue to cut in successive meetings after that. They are definitely more bearish than the street is on the economy. So that's going to drive sort of the Fed policy. But as far as the credit markets are concerned, it's more of a fundamental story. These are asset classes that trade at a spread over treasuries, and those spreads are very tight right now, as I mentioned before. I'd say that the real question is when the Fed cuts rates, why are they cutting rates? Are they cutting rates because we're heading into a recession? And we've certainly seen some softening of data, particularly in the labor market recently. So there are good reasons to be watching that very, very carefully. Or are they cutting rates because you have this, what economists call immaculate disinflation, and that you get the soft landing and that the Fed is able to cut rates on their own. And then that hopefully that will further ease financial conditions for companies and compel more investors to come into our asset classes.
Mike, I want to go back to what you just said a moment ago when we were talking about the loan market here. It could be in for a sustained repricing wave. There's also something you mentioned here in your notes. I guess more specifically, why? What would be driving that? And ultimately, then what do investors need to be prepared for or know about the impact that that's going to have?
Yeah, it's a great question. Just take a step back. As I mentioned, your spreads are very, very tight. And so why are we in this situation where it's good to be a borrower, it's good to be an issuer? Right now, companies have multiple channels that they can access capital. The private credit markets have grown a lot. And so therefore, they have quote unquote stolen some share from the broadly syndicated markets that we are talking about here. And so in order to compete, the broadly syndicated loan market and the bond markets are trying to be a little bit more issuer friendly. And actually you've seen our markets shrink a little bit. So that's also supported the technical, the loan market has peaked out at about 1.4 trillion in size. The high yield market shrunk by about 15%. So when there's more demand for credit assets, they're sort of chasing the same amount of paper and driving valuations higher. So that's sort of the backdrop. And you're not seeing a lot of new supply. Where would we normally get new supply? Well, often would come in the form of LBOs. But of course, the Fed has hiked rates and the Fed has made debt more expensive. So it's made buying companies and levering them up a little less attractive for sponsors. So we are operating in an environment of really a lack of paper. And so going back to the loan market, that has driven prices. It's about 70%. We estimate about 70% of the loan market is trading above par. And so when you look at, we've already seen a lot of repricings. May was a record month for repricings for the market. It got close to 100 billion of the market repriced. We've gotten close to 20% of the market has already repriced this year. But there's a couple of things that you're saying. Number one is some of the companies that repriced back in January are now coming back in and looking to reprice again. And often they're actually able to cut more this time than they did back in January. Number two is you look at the margins in the market. Issuers are still still paying a fairly high margin relative to history. If you look back to 2017, 2018, the last time that we had a very lengthy and extended repricing wave, margins came in a lot. They came in by about 60 basis points from 360 to 300. Right now, we're close to 340. So it tells you there's scope on that side. And then finally, with loans or floating rate assets, they float off of short-term SOFR. And so that means that right now, overall yields still look very attractive. And even if the Fed cuts 25, 50, 100 basis points, they still are very attractive from a spread, from an overall yield basis, and competitive to other asset classes like investment grade credit or high yield credit. So a lot of those tailwinds are in place for an extended repricing wave. The big question is going to be the fundamental backdrop and whether or not we're still headed for that soft landing, or some of the warning signs that we've seen recently are exactly that, warning signs that things could get worse.
Michael, in our final minute, I want to end on what you mentioned there about valuations. Can you talk a little bit more about what you're seeing under the hood with regards to what's sort of keeping valuations tight, and why you're not necessarily seeing a broader picture there of what the movement could look like moving forward?
Yeah, that's a big issue right now, because the average, so when people talk about the spread on the high yield market, they're talking about an average, but of course there's a distribution around that average. And so if you break the market down into the tightest to the widest names, the tightest names basically trade on top of, the tightest 80% of the market trades basically where it did in May 07, which was the all-time record tight. It's the distressed segment, which includes some communications names. That's a sector that, despite the fact that the growth has been resilient this year, it's still a sector that's quickly evolving and trades at a fairly wide spread. So when you look at it, look at the distribution, the reason why spreads don't even look even tighter than they are right now is because of this stubbornly wide tail. And some of those names might be heading to restructuring. So the spread may not be as meaningful for investors in terms of being able to capture that spread, because it might be more of a restructuring situation.
All right, Michael, we're going to have to leave it there. Thank you so much for joining us. We really appreciate it. That was Michael Anderson. He is Citigroup's Head U.S. Credit Strategy. Really appreciate it.